Imagine waking up,
Right.
pouring your morning coffee, and checking the news, only to realize that a geopolitical conflict unfolding thousands of miles away in the Middle East has just added $60 million to your company's operating costs.
Oh, wow.
For
Yeah.
just the upcoming quarter. I mean, boom, $60 million just gone from the ledger before the day even begins.
It's a staggering number to wake up to.
It really is. Like, how does a legacy manufacturing giant absorb a sudden, massive shock like that without completely derailing its entire year?
It takes a lot of maneuvering, that's for sure.
Welcome to the Deep Dive. We are so thrilled you are joining us today because we are unpacking how a massive corporate entity remodels its entire financial house, while navigating a seriously turbulent global market.
And the company we're looking at today is Owens Corning, which, I mean, they've been a cornerstone of American manufacturing since 1938.
Oh, absolutely.
Yeah.
I think most people listening probably know them best for their Pink Panther mascot, right? And that bright pink fiberglass insulation you see in pretty much every attic.
Exactly, yeah. But today, they are right in the middle of executing this massive strategic pivot. They are basically attempting to fundamentally reshape their identity, and they're doing it during a really complex macroeconomic cycle.
Right. And our mission today is to dissect exactly how they are pulling this off. We're using their Q1 2026 earnings presentation and the associated press release as our source material for this.
And there is a lot to dig into there.
Oh, tons. Okay, so let's unpack this. Where do we even begin to visualize a company making such a colossal shift?
Well, picture the backdrop changing for a second. If you were to look at Owens Corning, say, a few years ago, the visual would be this sprawling, somewhat chaotic, traditional construction site.
Okay, I can picture that. Lots of moving parts.
Right. You'd see a lot of different disparate projects going on all at once, different business units operating with, varying degrees of synergy.
Sure.
But today, I want you to picture that backdrop shifting into a sleek, highly focused corporate war room.
Oh, I like that. So much more intentional.
Highly intentional. The noise has been dialed down. The focus is singular now. And the data from Q1 2026, it reflects the immense tension of that transition perfectly.
Let's get into that data. Because looking at the top line numbers, their net sales came in at $2.3 billion.
Right.
Which, to anyone on the street, sounds like a mountain of cash.
Right.
But that actually represents a 10% decrease from the prior year.
Yeah, it's a significant drop.
We're looking at net sales dropping by $265 million.
And it gets more intense because their free cash outflow was, well, it was $387 million.
Exactly. But, and this is the crazy part, despite those drops in revenue and the massive cash outflow, they managed to maintain an adjusted EBITDA margin of 16%.
Wait, really? 16%?
Yeah. 16%, which translates to $369 million. And they posted an adjusted diluted earnings per share of $1.22.
Okay, hold on. Before we go any further, I feel like we need to clarify some of these financial mechanics for anyone who doesn't spend their entire day staring at balance sheets. Good idea. Let's break it down.
So an adjusted EBITDA margin of 16%. EBITDA is essentially their raw operational cash profit, right? Before all the accounting mechanisms like interest, taxes, depreciation are factored in.
That's right. It's the core operational profitability.
So you are saying they're keeping 16 cents of profit for every dollar they make operationally.
Correct.
But then we have a free cash outflow of $387 million, meaning they spent nearly $400 million more cash than they brought in during this quarter.
Yeah, and that is the crucial tension of this entire earnings report. The cash going out the door basically outpaced the cash coming in from operations.
Which sounds terrifying. Why is that happening?
Well, it's largely due to capital expenditures, working capital requirements, and the heavy costs associated with actually restructuring the company.
Okay, but wait. Brian Chambers, the CEO, is publicly calling this a resilient performance. I mean, I'm looking at a 10% revenue drop and nearly $400 million in cash leaving the building.
I know, it sounds contradictory.
Right. Like if I'm sailing a ship and I suddenly lose 10% of my speed while simultaneously taking on water to the tune of 400 million gallons, I'm looking for a leak.
Oh, for sure.
I am certainly not standing on the deck praising the resilience of my sails.
Yeah. I love the ship analogy, actually, but we need to shift the perspective a bit here.
Okay, how so?
Because trimming the sails on a ship absolutely means you lose some raw speed. But consider a scenario where you are intentionally trimming those sails because you are preparing to navigate a much tighter, incredibly treacherous channel.
Ah, Okay, so it's deliberate.
Highly deliberate. You are actively trading raw, uncontrollable speed for precision and maneuverability, and Owens Corning is doing exactly that.
So the drop in sheer volume isn't an accident.
No, not at all. It's not a market failure either. It is a calculated trade-off. They are willing to accept lower overall sales volume if it means achieving higher, more resilient profit margins on the items they actually do sell.
I see. So they are shrinking the total footprint on purpose just to become significantly more profitable on a percentage basis.
Exactly. And what's fascinating here is how they just executed the biggest move in this strategy, which really brings us to their major portfolio shift.
Oh, right. The big sale.
Yes. On April 30, 2026, they officially completed the sale of their glass reinforcements business.
Which was a massive part of their historical operations,
Yeah.
right? Because glass reinforcements go into like everything from wind turbine blades to industrial pipes.
Huge part of their legacy. But by selling off that heavy industrial component, they have effectively transformed themselves
Into what exactly?
into a pure play, branded building products leader. With a laser focus primarily on North America and Europe, they've entirely stopped trying to be this, general industrial materials provider for the whole world.
Wow. And from a pure balance sheet perspective,
Hmm.
they pocketed roughly $280 million in cash from that sale, correct?
Correct. And in addition to that, they anticipate making another $50 to $70 million over the coming year,
Just from what?
just from selling off the excess alloy materials left over from that specific business.
That is wild. Okay, so the enterprise-level strategy is clear on paper. You trim the fat, you take the cash from selling the non-core assets, and you use it to fortify the margins of the remaining business.
That's the playbook, yeah.
But, you can't live in a spreadsheet. To see if this new lean manufacturing model is actually working, we have to kind of leave the boardroom and walk the factory floor.
I completely agree. We need to look at the three remaining core product segments to see the real impact.
Right, because Owens Corning now rests on three complementary pillars. We've got roofing, insulation, and doors.
Let's look at the heavyweight first, the roofing segment.
Okay, let's do it. In Q1, roofing brought in $960 million in sales.
Yeah.
But that is down 14% from the prior year. Another massive double-digit drop in volume.
It is. But look at the profitability of that specific segment. They generated $231 million of EBITDA, maintaining a massive 24% margin.
24%?
Yes. Keeping a margin that high when your sales volume drops by 14% requires remarkable structural discipline.
See, this is the part that breaks my brain a little bit. How does a company lose 14% of its sales volume, but somehow maintain a 24% profit margin?
It defies traditional logic, doesn't it?
It really does. Usually when volume drops, factories run less efficiently, the fixed costs just eat up all the profits, and margins collapse. How do they defend that 24%?
Well, they utilized aggressive pricing power and operational leverage. First, you have to look at why the volume dropped in the first place.
Okay, why did?
It wasn't a sudden lack of consumer desire for roofs. It came down to market mechanics. Specifically, U.S. shingle demand was down across the entire industry in Q1
Why was it down across the whole industry?
because of distributor restocking dynamics. See, late last year, distributors bought a massive amount of inventory.
Oh, I see. So their warehouses were completely full in Q1.
Yeah, exactly. So they hit pause on ordering. Owens Corning knew this was a temporary inventory glut, not a structural decline in demand.
Got it.
Therefore, they refused to panic discount their shingles just to push volume out the door. They held firm on their pricing.
Ah, so they protected the value of the product rather than just chasing a quick sale to make the quarterly volume look better.
Precisely.
Yeah.
And furthermore, even with that temporary market-wide slump, Owens Corning noted their specific shingle volumes were actually beating the overall market.
So they are successfully taking a larger slice of a temporarily shrinking pie, all while absolutely refusing to slash prices.
You nailed it. That's how you defend a 24% margin.
Okay, here's where it gets really interesting, though. Because if we group the data and look at the other two businesses, insulation and doors, the contrast is pretty jarring.
It really is a tale of two cities within the company.
Yeah, because insulation brought in $867 million, which is a 5% drop, holding a 19% margin.
Right.
But then doors brought in $475 million, down 12%, with only a 7% margin.
Yeah, that's a stark difference from the high-flying 24% margin in roofing.
Right, so we're basically looking at a corporate structure acting like a highly managed investment portfolio. It's like a three-legged stool where one leg doors is significantly shorter right now.
That's a good way to visualize it.
Right now, insulation and doors are acting as the risk-adjusted defense. They are intentionally pulling back. Meanwhile, roofing is this aggressive growth engine generating all the raw cash flow to fund the entire pivot. But why are doors and insulation seeing these specific declines?
Well, it goes back to that concept of deliberate internal pruning. The declines in insulation and doors are driven by intentional structural divestitures.
Okay, so it's not failing product lines.
No, not at all. In the insulation segment, they certainly had some previous pricing actions that impacted volume, but the major factor was their strategic sale of a China building materials business.
Oh, of course. The moment you sell a business unit, the revenue it generated just vanishes from your top line.
Exactly.
Yeah.
You sacrifice the top line revenue, but you eliminate the operational headaches, the massive capital expenditures, and the low margin drag of running a non-core facility halfway across the world.
That makes total sense.
And we see the exact same strategy playing out in the doors segment. That 12% revenue decline wasn't driven by, a sudden halt in door installations across the country.
What drove it then?
It was specifically driven by the strategic sale of an Oregon components facility alongside the divestiture of a company-owned distribution business.
Ah, and running a distribution network is entirely different from manufacturing. I mean, the logistics, the trucking, the warehousing, it is notoriously low margin compared to producing a high-end branded building product.
Very low margin. By selling off that distribution arm, they instantly dropped their revenue in the doors segment. But long-term, it really leans out their operation.
So it's like pruning a tree.
Yes, exactly. If a branch of an apple tree is consuming massive amounts of water and nutrients but producing very little fruit, you prune it. You cut it off so the core of the tree can thrive. They're controlling their destiny by shedding these specific facilities.
Okay, so they're controlling what is within their power to control. But any manufacturer will tell you that the best internal strategy in the world cannot completely shield you from the global economic weather.
Oh, certainly not.
And right now, the global headwinds are really battering this newly remodeled house. The earnings report lists several heavy macro pressures, right?
It does. We are seeing sustained pressure on discretionary remodeling, meaning homeowners are choosing to hold off on updating their siding or finishing their basements.
Yeah, that makes sense with interest rates where they are. And they mentioned a slowdown in residential new construction in North America too, right?
They did. But if we connect this to the bigger picture, the pressure isn't just coming from domestic housing trends or domestic interest rates. The report highlights a massive, unexpected external shock that really underscores the extreme volatility of global manufacturing.
You mean the Iran conflict?
Yes, they specifically cite the Iran conflict.
Which goes back to the $60 million hit we talked about at the top of the show. Walk us through the mechanism of this. Like, how does a geopolitical conflict in the Middle East directly extract $60 million from a building materials company headquartered in Toledo, Ohio?
I know, it sounds disconnected, but it transmits directly through the global supply chain via energy and raw materials.
Okay, break that down for me.
Consider the primary ingredient in Owens Corning's most profitable segment, which is roofing. Asphalt shingles rely heavily on liquid asphalt,
Okay.
and liquid asphalt is fundamentally a petroleum byproduct.
Oh, there it is.
Right. So when geopolitical instability rocks the Middle East, global oil markets panic. The price of crude oil spikes. And within weeks, the cost of the petroleum-based raw materials entering an Ohio manufacturing plant skyrockets.
Wow.
Yeah. Owens Corning stated in their outlook that this conflict is projected to drive an incremental $60 million in costs for them in the second quarter alone. And that's stacking on top of ongoing input cost and transportation inflation.
It is just a phenomenal demonstration of how interconnected the global economy is. I mean, a headline breaks overseas and suddenly costs more to put a roof on a house in the American Midwest.
It's the butterfly effect in real time.
But how does a company forecast a sudden $60 million inflationary bill without completely tanking its outlook for the entire year?
Well, it comes down to diversification acting as a structural buffer. Operating globally exposes you to regional shocks, but it also provides regional counterbalances.
What kind of counterbalances do they have right now?
First off, they noted that European market conditions are expected to gradually recover. In fact, their European insulation revenue is already trending up.
Really? Why is that?
It's driven by this market recovery and some favorable currency exchange tailwinds. So basically, a manufacturing slowdown in North America is partially offset by a rebound in Europe.
Got it. So they aren't relying on a single economy to keep the lights on.
Exactly. And secondly, the report details this fascinating wild card that perfectly illustrates the complexities of international trade.
Ooh, what is it?
They are anticipating a potential $25 million refund in the second quarter
A refund for what?
for tariffs they previously paid under the International Emergency Economic Powers Act.
Are you kidding? Navigating international tariffs is an absolute labyrinth.
It really is.
So they pay millions in tariffs due to sweeping emergency economic policies, contest the charges, and suddenly might receive a $25 million government refund right at the exact moment a geopolitical crisis spikes their raw material costs.
The timing is wild, isn't it?
That is the definition of navigating the storm.
It really highlights how corporate finance at this level requires managing multiple, completely unrelated global timelines simultaneously.
Yeah, no kidding. Executing a massive strategic pivot, selling off legacy businesses, defending profit margins against inflation, and navigating international tariff law, it requires an immense amount of capital.
A massive amount, yeah.
Which leads us directly to the people funding this entire voyage, right? The shareholders. Amidst all this internal restructuring and external chaos, how is Owens Corning allocating its capital?
Well, they are heavily prioritizing shareholder value, which is basically non-negotiable when you're asking investors to trust a multi-year strategic pivot.
Oh, you have to keep them happy.
Right. Despite the macroeconomic headwinds and the calculated revenue drops we talked about, they returned $63 million to shareholders through a cash dividend in the first quarter.
Okay, $63 million is nice.
It is, but the headline number is far bigger. They remain steadfast on a publicly stated commitment to return $2 billion of cash to shareholders over the course of 2025 and 2026.
$2 billion over just 2 years.
$2 billion.
So what does this all mean? $2 billion is an aggressive flex of confidence. Looking at the report, they had 12.5 million shares still available for repurchase under their current authorizations at the end of Q1. So they are executing massive stock buybacks.
They are.
By reducing the number of outstanding shares on the open market, they inherently increase the value of every remaining share.
That's the math, yeah.
So they aren't hoarding cash out of fear of the macroeconomic weather. They are buying their own stock because they fundamentally believe this new, streamlined, pure-play business model is highly undervalued by the current market.
Exactly. It sends a remarkably strong signal of internal conviction. They believe in the pivot. But what is equally compelling is how they are pairing this aggressive financial strategy with rigorous operational and environmental sustainability, because it isn't just about the balance sheet.
What do you mean?
In Q1, they maintained a stellar recordable incident rate for safety of 0.46.
Oh, wow. Let's contextualize that number for the listeners.
Yeah.
A recordable incident rate of 0.46 in heavy manufacturing is staggeringly difficult to achieve.
It is incredibly rare.
We are talking about massive factories running 24/7 with heavy machinery, extremely high temperatures, complex logistics. A rate of 0.46 means that statistically, less than half a person per 100 employees experiences a recordable workplace injury in a given year.
It's an amazing safety record, and this raises an important question about the modern definition of corporate efficiency.
How so?
Well, for decades, the prevailing narrative in industrial business was that investing heavily in ESG, environmental, social, and governance, and obsessing over workplace safety was essentially a tax on profits.
Right. The old mindset viewed safety purely as a cost center. The assumption was that safety protocols slowed down production and basically came at the expense of shareholder returns.
Exactly. But what we are seeing with modern manufacturing leaders is a complete paradigm shift. Companies like Owens Corning are proving that leaning into world-class safety standards doesn't drain the bottom line. It stabilizes it.
Oh, that's an interesting way to frame it.
Think about the mechanics. Operational discipline on the factory floor translates directly to financial discipline in the boardroom. A safe plant runs continuously without the massive financial drains of costly shutdowns, equipment damage, or severe liabilities.
That makes total sense. If nobody's getting hurt, the line doesn't stop.
Exactly. Furthermore, they were recently recognized by S&P Global as a top 1% performer in the Sustainability Yearbook for the building products industry worldwide.
The discipline is interconnected. The exact same rigorous attention to detail required to prevent accidents on a high-speed manufacturing line is the discipline required to maintain a 24% profit margin in a declining market. You just cannot have financial resilience without operational resilience.
That's beautifully said. They are actively building a resilient company culture, which is far harder to replicate than a resilient product line.
Well, we have covered a massive amount of ground today. We have watched a legacy manufacturing giant fundamentally dismantle and reshape its identity.
We really have.
They shed their historic glass reinforcements arm to double down on becoming a highly focused, pure-play building products leader. We've seen how they managed to balance a 10% top-line revenue drop by deliberately pruning underperforming assets and protecting incredibly durable margins through serious pricing power.
And we tracked how they are weathering severe external shocks. From U.S. distributor restocking dynamics to a sudden $60 million inflationary hit driven by Middle Eastern conflicts.
All while maintaining the confidence to execute a $2 billion return to their shareholders. It really is a masterclass in corporate remodeling.
It absolutely is.
But before we sign off, there is one highly specific detail from this earnings report that provides a fascinating window into corporate valuation, and I really want to leave you, our listener, with this thought to mull over.
Oh, the alloy.
Yes, the alloy. When Owens Corning detailed the divestiture of their glass reinforcements business, they noted they expect to make an extra $50 to $70 million over the next year just from selling off excess alloy.
Which is essentially highly valuable scrap metal. We're talking platinum and rhodium alloys used in the glass manufacturing process, just sitting around from the old business.
$50 to $70 million of value just sitting there in excess materials, completely disconnected from their core future business. It makes you wonder.
What else is out there?
Right, exactly. When a legacy manufacturing giant finally decides to strip its secondary parts all the way down to the studs, what other hidden high-value assets might be lingering deep in the dusty corners and complex balance sheets of other global corporations?
It's a great question.
What incredible value is just sitting there, waiting to be unlocked by a fearless strategic pivot? It completely changes how you look at the foundation of these massive companies.
It proves that sometimes the most valuable assets aren't on the billboard. They are hidden in the framework.
Very true. Thank you so much for joining us for this deep dive. Keep asking questions and always remember to look beneath the surface of the numbers because the real story is usually hiding behind the drywall.